Standard RSI tells you where momentum sits between 0 and 100. But in strong trends, RSI can hover between 40 and 70 for weeks without ever touching an extreme. Stochastic RSI fixes that blind spot by applying a stochastic calculation to RSI itself. You get a hypersensitive oscillator that maps the position of RSI within its own recent range. Today, we break down the math, the signals, the traps, and how to use it without getting chopped to pieces. The math is simple but worth understanding. First, compute a standard 14-period RSI. Then, over the last 14 RSI values, find the highest high and the lowest low. Stochastic RSI equals current RSI minus the lowest RSI, divided by the highest RSI minus the lowest RSI. The result is a value from 0 to 1, usually scaled to 100. Most platforms then smooth it with a 3-period K line and a 3-period D line, just like the classic stochastic. Readings above 80 signal overbought conditions, below 20 signal oversold. Crosses of K above D inside the oversold zone are bullish triggers, and crosses below D in the overbought zone are bearish. The key thing to remember, this is momentum of momentum, so it whipsaws fast. A reading of 100 does not mean the top, it means RSI is at the top of its own recent range. Big difference. In a strong trend, plain RSI may never hit 30 or 70, leaving mean reversion traders waiting forever. Stochastic RSI rebases RSI against its own recent extremes, so it cycles through overbought and oversold regularly. That gives you many more potential trade triggers and earlier warnings when momentum is exhausted within the prevailing trend. That sensitivity is also the weakness. Stochastic RSI can pin at 100 or 0 for extended runs in trending markets, generating false reversal signals one after another. Traders who blindly fade every overbought print get steamrolled. The fix: never trade stochastic RSI signals against a dominant trend without confirmation. Treat extremes in a trend as continuation evidence, not reversal evidence. Here are the setups that hold up. First, the trigger. Wait for K to cross D in the extreme zone, then exit the zone. Crossing back above 20 after being oversold is a stronger long signal than the cross down there. Second, demand confluence. Price reclaiming a key moving average or holding a higher timeframe support. Third, use the higher timeframe stochastic RSI to define direction and the lower timeframe to time entries. For exits, the opposite zone is your alert, not your trigger. When your long and stochastic RSI reaches overbought, tighten stops rather than dumping the position. Take partials on the first bearish KD cross out of the overbought zone. Full exit comes when price structure breaks, or when a higher timeframe stock RSI also rolls over. This staged approach keeps you in winners while protecting gains. Divergence on stochastic RSI fires earlier than on plain RSI, which is both a blessing and a curse. Bullish divergence. Price makes a lower low, stock RSI makes a higher low. Bearish. Price prints a higher high, stock RSI prints a lower high. Because the indicator is so reactive, demand confirmation from a candle pattern or volume spike before acting. Single bar divergences are noise. Multi-swing divergences carry weight. Here's a clean teaching case. Price pulls back inside an uptrend. Stock RSI dives below 20 and pins for several bars, scaring out weak hands. Then K crosses D and both lines push back above 20 while price reclaims the 20-period exponential moving average. That confluence is your entry. Stop goes below the swing low. Target: prior high, with partials when stock RSI re-enters overbought. Now let's pressure test on real price action. On the Apple daily chart over the past year, watch how stochastic RSI flagged momentum exhaustion at major swing points. Notice the false signals during strong trend legs and how filtering with a 50-day moving average direction would have eliminated most of them. The pattern is clear. Trade stock RSI signals in the direction of the longer trend and skip the counter-trend triggers. Stochastic RSI plays well with trend filters and volume tools. Pair it with ADX above 20 to confirm a trend exists, then use stock RSI to time pullback entries. Combine with VWAP or anchored VWAP for intraday mean reversion plays. Add on-balance volume to validate divergences. Avoid stacking it with plain RSI or full stochastic, since you're just rereading the same momentum information with a different lens. 3 mistakes kill traders using this tool. 1. Treating every overbought print as a short. In trends, that's a recipe for losses. 2. Using the default 14-period settings on every time frame without testing. Faster time frames often need longer smoothing. 3. Ignoring the gap between stock RSI and price. When the indicator is screaming reversal but price refuses to break structure, price is telling the truth. To recap, Stochastic RSI is momentum of momentum, normalizing RSI within its own recent range to surface extremes that plain RSI misses. Trade crosses out of the extreme zones in the direction of the higher time frame trend with structure and volume confirmation. Tomorrow, pull up your favorite chart, add stock RSI on 2 time frames, and mark the last 10 signals. Count which ones worked and what filtered the failures. That review is worth more than any tip. This is education, not financial advice. Trade your own plan. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.